Good morning and welcome to the Monday Call brought to you by NZ Funds. I'm Stephan Clark, Chief Client Officer at the firm. After a volatile August, the US share market is reaching new highs, and it's not just big tech driving the gains. Optimism is spreading, boosting sectors such as industrials, cyclicals and small caps. Meanwhile, back at home, the NZX is still below its 2021 peak, but New Zealand shares have shown signs of recovery, rising 7% over the last 3 months. This morning we're speaking with Mark Brooks, CIO at NZ Funds, to break down the major factors that are shaping markets. We'll be covering the outlook for inflation and interest rates, why we expect confidence in the New Zealand economy to grow, and what triggered the sudden market drop and bounce back in August. We'll also revisit the importance of staying invested during markets' ups and downs and how NZ Funds is positioning clients' portfolios for today's market environment. Mark, it's great to have you back on the call. Welcome.
Morning.
Hey, let's kick off with what happened in August. Can you explain the sudden market drop and bounce back, and where do we think it came from?
Cool. First of all, probably should explain it because hopefully a lot of people were not watching and completely missed it. Essentially, the US share market had a little tantrum during the first week of August, I think is the best way to put it. We saw new highs in the middle of July, and then it rolled off a bit after that, and you had a period of sort of 3 or 4 days where markets saw 2 -3% days. So at one point, sort of from the high in sort of 15th of July through to sort of 6th or 7th of August, the US share market ended down almost about 7% over that period. So given we've had a long period of sort of really positive numbers, that was a bit of a shock for a number of people. And as always, you got that situation where the newspapers love to sort of lead with that headline. I can't remember the headline, but shock down days or
Chicken Little?
Yeah, exactly. Tumultuous scenes on US share market, etc.
Men with their palms of their faces in the palms of their hands looking at screens.
What they never report is the fact that you get a bounce back afterwards. So what did cause it? Look, I think there's always a narrative, there's always a story. In terms of probably this time around, the story really was a couple of things. One, you saw very much a number of data points out of the US that were weaker than expected. Primarily, we've probably got a whole lot of background noise with emergency services in the background, but a number of sort of data points, the primary one being US jobs. And all of a sudden there was this concern that actually is the economy slowing a lot faster than people had expected. So that was sort of the reason for it. But I think equally at the same time, you've got to step back and say, where are we in the year? Late July, early August, peak holiday point in the United States. Markets are thin. People are on holidays. They're likely anyway to be, as you go into a holiday period, sort of, books are a little lighter. People have, if they've had positions on, certainly incentivized probably to take them off as they go on holiday and not put them back on. So you did see a situation where you had that sort of event. You did have another event in Japan, which in terms of the Japanese government actually, the Japanese Reserve Bank raising interest rates. And that saw the yen strengthen quite rapidly. And again, you do see a decent number of leveraged strategies. Gets a bit sort of pointy-headed, but a number of those strategies essentially sell yen and invest because their funding rates are very cheap and invested elsewhere at a higher interest rate. Yen rapidly strengthening meant that they unwound a lot of those. So I think that's the story. I think a better way to put it is that you'd had a period of positive numbers. Market had probably got over its skis, or put it another way, the bungee had become a bit stretched, and you just had one of those sort of reset periods. And ultimately, we would view them as being really healthy for markets. Generally, if you are going to have a big issue in the market, it often happens quite slowly. Yeah, people go, well, actually, the world is changing. I don't want to own this asset, or this asset has got too expensive. I see better opportunities elsewhere. That actually tends to happen quite slowly. So, in terms of big bear markets, the tops don't tend to be violent like that move in early August. They do tend to be slower. So, from that point of view, yeah, it's actually healthy because you have a quite a rapid change in valuation. A number, especially those leveraged strategies, take money off the table. That actually means that there's more money going forward to buy back into the market. And it's interesting that actually sitting here now, markets are basically back at their peak. And you haven't seen, to a degree, some of that leverage money come back. So it actually gives us a reason, not the only reason, but a reason to say, well, we do think the market is well set up to go higher going forward.
Okay, awesome. So you use the word the markets are thin. What do you mean by thin, and why does someone going on holiday make a difference to the pricing of an asset?
Well, I think put it in a different respect. Think about sort of auctions. In terms of houses, during peak periods, you might have an auction room full with 50 or 60 people. If they were holding an auction on the 3rd of January in New Zealand, how many people would you get? Probably 3, if you're lucky. So from that point of view, it just means that the number of people sort of transacting out there is much lower. So volumes are lower. And that can, if there are less buyers and sellers being active every day, it can end up with a situation just where markets move a little further than they would have otherwise.
So people who feel they have to sell to the nearest buyer, and the nearest buyer just happens to be further away in the price.
Correct. Yeah.
Okay. So what did you take from the last month and these gyrations, if you will? How should investors think about it, and what would you say to investors who have just sort of either acted on those moments or who are sort of looking back on them and still feeling a little bit anxious?
Look, I think it's about stepping back and thinking about how do markets work, and especially financial markets, because they are priced every day, end up becoming a more extreme version of this. But it's no different to, again, pricing in houses, etc. That price is ultimately the average of people's expectations as to where they see the world, and it's changes in those expectations that make market prices change. Now, if you get sudden events, sudden change in expectation, maybe that is very founded, something like COVID, or it is actually people just reacting rather than thinking about it. And in the example of of August with the US jobs data, we sent out a little note that sort of went through the factors. Has something changed? Should expectations, or should our expectations be changing? And from our point of view, the two things we looked at in terms of that job numbers. One, what is happening to economic activity? Yes, it has been slowing, but Q2 GDP was somewhere in the region of, I can't remember the exact number, 3.6% or something like that for the quarter, an annualized number, but for the quarter. Adding back the inflation amount gives you a quarterly GDP number on an annualized basis of sort of north of 5.5%. That's pretty robust growth, even if it is slowing in the US. Likewise, what is happening to unemployment? It is rising, much like it is in New Zealand, but from record low levels. And if you look back through time, unemployment in the US is still below much of what we saw during the 2010 period. So, all of that sort of said to us that actually, yes, there might have been a sudden change in expectations, but we don't think that change is warranted, and we're entirely happy to be invested. And we expect markets to revert relatively quickly to where they were, which pleasingly has happened.
Fantastic. So it's not just, job numbers and investors' expectations that have been changing, but monetary policy has slowly been changing, hasn't it? Can you take us through where we're at now in the cycle, and how is it different in say, the US, Australia, and New Zealand? Because, as I understand it, they're all in very different places.
They are in different places, but at times it's not that different. I think what is been, or what we potentially forget is if you look at the numbers, actually the process since the start of COVID has been very uniform across the Western world. Lockdowns were broadly at the same time. They were different lengths, but broadly at the same time, whether you're in New Zealand, Australia, UK, the US. Government responses were very similar. Start spending money, a little different in different places. US actually sent checks. They didn't do that here, but certainly government spent a lot of money, supported the economy, and interest rates went very, very low. And whether you're in New Zealand, Australia, the US, happened everywhere. Move forward, interest rates rapidly moved up, and that's a slowing force on the economies. Where we've moved to now is really we're moving outside of, except for, say, Australia, most Western economies have moved into that phase of cutting interest rates. They've said, well, actually, inflation has come down. Job done, tick. We're starting, economies are slowing. You're seeing more weakness in the labour market, tick. That, it's taken away those pressures. So we can start to take our foot off the brake. And you're seeing that. We've talked before, we've already seen Bank of Canada's cut interest rates, Europe's cut interest rates, and clearly here the Reserve Bank ended up cutting interest rates last time, and that was much earlier than they were talking. Back in May they were saying it was going to be the end of next year. All of a sudden you've seen a cut before the end of this year, and generally that's a reflection that I suppose at its simplest, things have returned to normal. Those stresses have moved out of the economy. Australia is a bit different. Australia never raised interest rates as much. So I suppose from that point of view, it seems, and again at a very big picture, that it would be natural that their process of inflation coming back down maybe takes a bit longer because they haven't been on the brakes as hard. And that seems to be where things are in Australia. So they're more balanced. They're still probably in that stage of, do interest rates move up or do they come down?
Okay, so what key indicators are you looking to at the moment to get a sense of the direction of inflation and interest rates, and then obviously there's economic growth that plays into it?
Yeah, well, I think that one of the things we're watching closely at the moment, and especially at these sort of points where you have a change, is again that idea of expectations. If we think about, and probably useful moving here to New Zealand at the moment, if we think about the economy, it's slow. We know it's slow. Anybody on the street will tell you that life's pretty hard. Go to restaurants, etc. Generally, they're not that busy. That is what is happening now. And given interest rates have been high and are still high, they're coming down, but they're still high, you would expect that slow activity to continue for some time. But equally, if you think back to my original point about what are markets, they are really the aggregate of people's expectations. In terms of the slow activity, that expectation is there. It should be in the market price, especially in New Zealand, because we've had a long period of slow activity. It's a very real situation where that bad news or the bad activity should be in the price. Now what we're looking at is how do those expectations change? And ultimately for, say, share markets, it's earnings that really drive and probably at this point may be more important about driving future expectations, because investors and companies will be looking forward and saying, well, actually economic activity now is slow. Come through to March next year, it might still be slow, it might still be tough, unemployment's probably still rising, but we're more positive about the year end. We expect better earnings in late 25, and that's what markets will start pricing in. So it's really about thinking about seeing, is there a point of inflection where we start seeing better numbers? In New Zealand, we probably still see economic data that's negative for a period of time, but that trend should start changing as interest rates come back.
Okay.
It might be slow.
We'll dig into New Zealand in a second a bit more, but on the global stage, particularly at the end of last year, there was a lot of talk of the Magnificent Seven and AI. In fact, I've joked about how we managed to make it through calls without talking about AI in the past, so it was everywhere. And then in the first half of this year, I guess the hype sort of continued, but not, or the interest, I should say, continued, but not with the same vigor. And now there's a lot of talk about a broader based or a rotation out of the Mag 7 into other asset classes, more traditional share market companies. Can you take us through why now, and what do we mean by even traditional companies, and what does that mean from an economic and growth standpoint?
Yeah. I'm going to sound a bit like a broken record, but again, it comes back to that expectations point of view. You saw last week NVIDIA, the poster child for AI, the maker of the GPUs that power AI, reported their earnings. And actually, when you look at their earnings, and I've used this stat before, back in 2017, NVIDIA sold to data centers $5 billion per annum of equipment. By 2021, that had doubled to $10 billion. Last quarter, they sold $28 billion of chips to data centers. So, again, by any maths, those are stunning numbers that really, they were better than expectations, but we got to the point where people knew about that. It's in the price, and actually published expectations were about where they reported. People wanted to see a better number. So actually the response to the result was actually a bit lackluster, and NVIDIA shares have traded down. If we think about the other parts of the market, where has with interest rates being high, what type of businesses does that impact? And we've talked a lot that say New Zealand dominated by utility companies and business and infrastructure businesses, ones with lots of assets, and you've got to finance those assets. So when interest rates are high, that tends to weigh on it. In a similar way, if you look at, say, smaller companies in America, tend to have a little more debt, tends to be more floating rate rather than fixed. So as interest rates move up rapidly, they have more of an impact from that. But broadly, with interest rates coming down, you've seen a slow rotation start to happen. And I think, if you sort of touched on New Zealand share market was up sort of 7% over the last 3 months. If I sort of go through the list, you've seen that sort of quite, that pattern re-emerge. NASDAQ up a little over 1% over a 3-month period. Yeah, kind of not bad, but not stellar numbers. But if New Zealand in that 7, the Russell, which is the small company index in the US, up about 9.5%. The broader, the S&P sort of 3.3, and the equally weighted S&P sort of 6.7%. So one that doesn't take in so much of those big Mag 7 weights. So from that point of view, starting to see that little bit of a rotation. And that is natural. One thing we do see in markets is they do tend to be mean reverting. For that sort of simple reason that I mentioned earlier, is that you get to a point where people go, well, actually the returns I see going forward are not there, so I'm going to move my money. And that's why markets tend to be mean reverting.
Okay. And so if it is true then that that growth is becoming more broad-based as interest rates come down, and smaller companies, industrials and cyclicals and so forth, are finding it easier to grow and deliver higher earnings, we can expect to see that flow through across the board. It's not that the rotation is that tech stocks become completely out of favour and other stocks go up. It's that, generally speaking, it's felt across the whole market.
Exactly, and I think that's a really good point, and one which I sort of slightly have missed is, it's not that we're negative on tech. It's really just that sort of weight of money to tech has moved there. There are still plenty of reasons why lots of those technology names will still do really well, but there is a case for a broader group of companies and a broader, I suppose, lifting of the tide is probably the best way to put it. And that's really positive and really quite exciting for markets. It's just generally it means that one of the challenges as an investor over the last couple of years is actually that window or broader returns have actually depended very heavily on the Magnificent Seven, on a very small number of names. And if you haven't necessarily owned those, you haven't sort of had such the the return outcomes have been quite different. So from that point, having a broad array of names is really positive. And again, I think it is that issue that, and I think we had this discussion earlier in the week, you forget at times where performance comes from. If we go back over the last, what was the number you had, 15 years or 10 years? 10 years. New Zealand has actually outperformed the US share market.
You wouldn't believe it.
Which seems pretty odd, given you've had a New Zealand share market which really has gone sideways for the better part of almost 5 years. It just shows that you had a period during that 2000, sort of mid-2010s, where New Zealand massively outperformed. That outperformance eventually comes to an end, and doesn't necessarily say it needs to perform badly. It may just underperform relatively going forward. So from that point, we think tech is still fine. It's just maybe some of the big gains may not be seen there to the same degree.
That whole price to perfection, with which NVIDIA always faces, with everyone paying so much attention to it and there's so much interest in it as a business, is a fascinating problem that they face, because almost no matter how well they do, they'll get after reporting a difficult response from the market.
And again, that's why you do need to step back and say, well, where do I think earnings are going? If they are earning a lot of money at the moment, what am I paying for those earnings? And that's the decision that we need to go through with all the positions we have. Is what is the expectation and what are we paying for that?
Okay, let's look at New Zealand a little bit deeper. So, how would you describe the biggest challenges facing the new companies on the New Zealand Stock Exchange today, and where do you see that lifting, or how do you see that lifting? Because you have become, as I understand it, more optimistic about the market locally. There's a couple of big factors that play into that, but it's sort of predicated on some shifts.
Yeah. Look, I think there are a number of layers to that question. There are a decent number of challenges in many respects for New Zealand companies on the stock exchange, and for us as investors, we'd like to see more. Maybe there's a lot of discussion about infrastructure. It'd be great to see some way to get more infrastructure businesses on the New Zealand exchange. We'd love to see that. But generally, I think the question that we're trying to sort of think about is, how do earnings change? If we look at valuations, and again, coming back to the performance of the New Zealand share market, the 5-year annualized return on New Zealand shares is about 2.2%. Basically sort of break even. And that is a reflection that New Zealand shares did get very expensive. They've come back, the earnings have built, and they've now sort of come back to a more of a fair value type valuation. But we're also conscious at the bottom, and we do think broadly we're at the bottom, is that people, because they've got a tough world around them, are not very positive about their expectations. So essentially the earnings number that is going into that valuation calculation is pretty conservative, it's pretty depressed. What we would expect is, maybe in a year's time, or maybe 2 years even, that those earnings actually end up being much better than people are expecting. So rather than being fairly valued, actually the New Zealand share market might at this point be quite cheap. So for us, it's about thinking, what type of businesses are earnings going to change? And generally our portfolios have been heavily weighted towards those infrastructure and utility names. mainly because, one, they offered good returns in terms of their expected return, but, they had stable earnings. They are defensive names. And they're still good businesses. We still like them. We still own them in the portfolio. But at the margin, making some changes in terms of looking for more cyclical businesses, ones which actually will benefit going forward and have conservative expectations about their earnings at the moment. People aren't, we've arguably come from pricing in that sort of very blue sky summer day optimism. We're back in that sort of middle of winter, slightly depressed world. We think we're going to move, maybe not back to the optimism, but somewhere in the middle. So what types of businesses benefit from that? And broadly, those are sort of more cyclical ones. Probably, don't name names, but you sort of sectors, things like property will do it better. There's certainly other sectors within that ones that are more responsive to consumer spending, things like that.
Okay. I've had the pleasure of being on the road meeting clients across the country over the last few weeks, and one of the things that really stands out to me is, and something you allude to, is the sense that because we are doing it really tough in New Zealand at the moment, that other parts of the world must be in the same place. And when I explain to and talk with clients, and we talk about the size of the New Zealand economy compared with the rest of the world, and there's often and that say the US is growing really strongly, and in spite of its challenges, and there's something of a surprise there. And so the benefits, I guess, of diversification in a portfolio and not having everything orientated towards one market, whether it's New Zealand, Australia, or anywhere, really come home in those moments. On that, then the conversation typically flows to drawing parallels and distinctions between New Zealand, the New Zealand economy, and say the Australian economy and the American economy, and the different makeup of what's underneath it, at least for investors. Do you want to talk a little bit about that? Why is New Zealand not growing in the same way that the tech companies have been, like America and Australia is again doing it differently?
Well, I think, again, it is a bit of a cliche, but first of all, markets, financial markets are not Main Street. So what people are seeing in their daily lives, in their own businesses, probably smaller businesses, etc., can be very different to what financial markets are seeing. So that's, and that can happen anywhere. But having said that, if we think about the New Zealand share market, that is quite sensitive to what is happening domestically in terms of economic activity, because you have names like Spark, Meridian, etc. Ultimately names, and I suppose the energy companies are probably a bad example at the moment, given some of the drier weather. But generally, if you sort of take out that sort of one-off boost they've had from that, their earnings are very reliant on economic activity, and that's been slow. So that's generally kept it quite low. Whereas the US, you have a financial market that is made up of, dominated by sort of technology companies. Got a large percentage of healthcare companies there. In many respects, those sorts of sectors aren't particularly challenged by economic activity. They do at the margin, but Microsoft can grow at 20%. It doesn't need 5, 6, 7% GDP growth. So from that point of view, that means you can end up with quite a difference there. But ultimately, it comes back to that sort of view is, what is an economy doing and what are the impacts on that economy, and that will sort of flow through to what is happening. The US ultimately still quite internally focused. They drive their own growth. Somewhere like New Zealand, exports are important. Australia, equally very important exports, and for them, much more focused towards China. China's a massive trading partner for New Zealand, but much more so in the case of Australia. And China is one we haven't talked about at the moment, but that is an economy that is in many respects going through its own version of the GFC in terms of their housing market. And much like the US GFC, house prices down significantly, massively impact people's ability to spend, but it's also very pervasive across an economy. So, the government there is starting to go through, I suppose the cadence is increasing a lot in terms of their helping the economy. But most of the expectations there are very, very negative, certainly from a financial market standpoint.
Which I guess might translate to Australia or it might not. It ultimately comes down to whether the government steps in and does infrastructure projects or,
But again, in terms of that balance of could it get worse? Certainly, but is it going to get a lot worse? Probably unlikely, because the government is likely to step in the case of China, and they have a lot of capability to do that. If that does happen, then that does increase the demand for Australian product, for iron ore, things like that, for copper.
Yeah. So the Reserve Bank in New Zealand has obviously started bringing rates down, and it's a big step in the right direction, you could argue.
Yep.
When does that start translating, or how does that start translating to New Zealanders feeling wealthy again?
Good question, and that's the magical if. I think there's a couple of aspects to it. One, actually, I suppose the good news is, yes, the Reserve Bank has cut interest rates and said that they now feel comfortable to be on a path to continue to cut interest rates. In terms of their discussion, they will always say that they're going to do that slowly. Financial markets, by their nature, look to price in where they think things are going to go quickly. And we've seen some really significant moves down in interest rates. Probably at, in terms of the extreme, something like a 2-year wholesale rate peak was about 5.2% this year. Today it's about 3.96%. So we've seen, much more than sort of 1.3% come off that. And that is translating to the discussion we're seeing out there with mortgages coming down quite a lot. However, I think there is the flip side, is that there's probably three things. One, you get the sense that this has gone on for a period of time. People who have borrowing or their balance sheets are stressed. So I think it will take time as they get a little bit of marginal help in terms of interest rates coming down, that they will look to rebuild balance sheets. So from that point of view, I would say that the spending will improve, but it might improve more slowly than people would expect. Wouldn't expect a really quick bounce back. The other one is also in terms of, say, if we think about will that encourage more lending? Still think about what is the landscape. Yes, interest rates have come down. You can now get a mortgage in the mid-sixes. That's broadly probably where what I call the back book, so the average of all mortgages kind of sit in terms of the interest rate they're paying. But also remember, banks now still have to have that 2% stress test. So they're still going to be stressing your ability to repay at 8.5%. So from that point, difficult to see that people are going to rush out there and start borrowing again, because there's still some challenges from that. And then the third one is really, and this is, I don't have a great feel for how important this is in the domestic economy. It's a little bit of a discussion that's going on in the academic circles, is there what we call a J-curve effect, in the sense that do those who have money to invest in term deposits get impacted faster than those who are on mortgages that roll over more slowly? So perversely, the early interest rate cuts actually cut the spending power of those with term deposits. So potentially that may cut some degree of spending in the economy before you get that boost. So you get that sort of J shape, you get a down before you get an up. So that's a long way of saying, in terms of broader activity in New Zealand, we do expect it to improve without a doubt. But to start with, things may be more challenging. We're likely to see higher unemployment. Unemployment's a very lagging indicator. But again, we're trying to, for us, we need to look through that and say, what happens as we come out the other side? And we do think with interest rates coming down, it's very much, the foot's coming off the brake, so that is a positive.
I guess another way of framing this from an investor's perspective is, as you're going into a difficult period, having really high quality, resilient earnings really makes sense. And as you're coming out, then you can start taking a bit more earnings risk, if you will, and investing in cyclicals and other businesses that are more economically or associated.
Well, I think also, and you did see this in the US back in sort of 22, where the market was down for most of the year and then bounced pretty strongly, is I think what you are seeing amongst companies locally is tough periods force companies to optimize, become a bit leaner, a bit more efficient. And when they get that dollar of sales back, it actually translates to more earnings than it would have previously. They have some operating leverage. So actually you can see businesses that may not actually be massively cyclical, but they've just cut costs, sort of taken away spending that they didn't need to do, and that actually ends up being pretty positive for shareholders as you get some of those sales back.
Right. Okay, last time you were on the call, it was 6 weeks ago, and there was changes afoot or underway in the US political space, and a lot has happened since then. How do you think, if at all, the resurgence of the Democratic movement and Harris sort of grabbing the party by the horns and trying to push it forward is going to change the economic outlook for investors?
That's a good question, and probably not one I have a clear answer for, is ultimately the way I put it. I think, you could argue a little bit that move in August in terms of markets being unsettled was partially in relation to that, is that markets had probably coalesced on the fact that Trump was going to get back in, and then for various things that was positive, for other things it was negative, so that expectations had narrowed as to what the outcome. With the Democrats being now more of a force, it would appear, from that point, expectations become wider, and that's possibly a reason, not necessarily because of Harris, but just because you had different expectations as to why markets have moved around a bit. Going forward, I suppose again looking at past history, the two things that sort of stand out is one, the last couple of times, Trump versus Biden and Trump versus Clinton, there were quite big differences 3-4 months out in terms of who was leading in the polls and who wasn't. Ultimately, both came down to very tight races at the end. So, in many respects, we'd expect that to repeat this time again. But we still fall back on the discussion, which really we've had all year, is that the history of US elections shows that markets, again, as they get closer to an election, become more comfortable with the outcome, less worried with the outcome, and actually tends to end up being quite positive years often. It's one reason why we're, from the portfolio standpoint, we're still fully invested. We've made very few changes in the portfolio. We just want to make sure that we do think the outlook remains positive, especially for US share market into the end of the year, given it's an election year. So we want to make sure that investors are positioned to benefit from that.
Okay. You touched on China before, and obviously it's going through its own difficulties. Are there other major factors, or is there more sort of other components to the China story that are top of mind for you and it's sort of at a global macro level?
I think the big challenge with China is timing. In many respects, what they appear to be doing is, in some respects, not any different to what has happened in New Zealand and the United States, even Japan, as they have gone through, or probably Japan's a good example, have gone through a situation where Japan rebuilt its economy by being an exporter, by producing cheap product, exporting it. Then it moved up the value scale and definitely moved up the consumption scale in terms of domestic consumption. China being a much bigger economy, and I touched on before that the US doesn't really rely on exports. It's very self-sustaining in itself in many respects. China's got the size to do that. They've been an export-led economy. What they're trying to do is move towards a consumption-led economy. And as part of that, one thing they wanted to do was reduce the focus on housing as the only one of the few forms of investment. If you're going to have a domestic led economy with domestic consumption, you need strong Chinese companies ultimately to provide product for that. So, at a wider level, what the Chinese government's been doing has been looking to build their financial markets. Arguably, the tightening on the property market has certainly had unintended consequences, and they're probably much deeper and more problematic than what they expected. But it is a longer, if you take a very long-term view, what they're trying to do is move a little bit of that investment money across the financial markets, and encourage perversely, the type of activity that happens in the US in terms of, businesses like an NVIDIA. Encourage those businesses through domestic, financial markets. And that also explains some of the other changes, the crackdown on some of the tech companies. In many respects, that was really about putting rule of law in place. They had no laws on data. Data privacy laws that we have here, for example, they weren't really in place in China. So a lot of their crackdown and some of those activities are there. Other ones were, their takeover law. Like the Commerce Commission would have a view on takeovers here. They were being ignored in some respects by some of those tech companies. So it's about China going through that process that, in fact, many Western nations have already been through. So the challenge for investors is that could be a very long time, but it's also about sort of saying, well, are there opportunities there? And, I think one example, and where are you buying something in terms of those expectations? Clearly, US tech companies, the expectations are very high. Their earnings are very high, but their expectations are very high. Another example in terms of the Chinese world is, something like an Alibaba. Not suggesting it's a good investment or not, but if you look at Alibaba, that is a $200 billion US business. It has $100 billion in cash, and you can buy it on 6 times earnings. Broadly, and this might be a stretch, but if that was sitting in America, that would probably be on 25 or 30 times earnings. There may be reasons for that, but your starting point is that the expectations are very low. So from that point of view, China is something we continue to watch, continue to be interested in, because the expectations and valuations are very low.
The difference between what you pay for similar companies in emerging markets and the US is it's at its highs or very close to. So I suppose if you're a global investor, that does start, cause you to ask some questions about where you want your capital to be, at least in a portion of it deployed.
Yeah, and as an example of that, and I don't mean this to be too flippant, but it is always our role, I think, to sort of ask those questions and kind of, have one client this year sort of say, well, because the US is doing well, shouldn't we have all our money there? Why do we have money in New Zealand? For us, it's always about having a portfolio diversification, and that because there was a long period when New Zealand really outperformed, and it did nothing for a long period of time. Move forward 5 or 6 years, maybe the US is in that situation.
And there's, of course, tax policy. If that's we need to overlay on top of it all as well, which can change outcomes.
Which is really important as your horizon increases, right? Something it's probably a little bit of a tangent, but something we've talked about a lot with clients in terms of interest rates coming down. In many respects, with interest rates being so high, having cash investments in New Zealand has not been probably quite a good outcome over the last couple of years. But as you hold that for longer periods of time, and as the interest rates come down, you've got to think also about those tax. What do you get back in the hand? And in terms of the tax policy, it's something that doesn't get talked about too much, but it's actually very positive towards share investments in New Zealand. If you're holding term deposits or you're holding bonds, you're going to get fully taxed. That might be at 28% in a pie, or it might be higher if you're holding it in your own name. Holding New Zealand shares, broadly, because of imputation, the imputation credits, you don't really get taxed.
Not in the hand of an investor.
Yeah, not in the hand of the investor because tax is being paid by the company. And foreign shares, slightly different, foreign dividend rules, but broadly those tax rates are very low. So for a 1 or 2 year period, that's not going to have a big impact. But as you move out to sort of 5, 7, and 10 years, that tax wedge is critically important to people's outcomes.
Okay. My last question for this session, it's been a great discussion, Mark, is what are the lessons you've taken out of the last few months, and how are there any new lessons, or are there any lessons that you've been reminded of that investors today and listening would benefit from hearing?
Good question. I think the main one, as always, and we try and sort of remind it ourselves as much, is have a plan. Because if you work through and think about your different outcomes and different scenarios, what if we end up in this situation? That gives you a playbook, a true north, for want of a better word, to say, well, I'm not sure what's going on. Let's go back to where we expected to be. Or, something has changed. How does that impact my plan? And if it does impact that, then there's a reason to change. But if it doesn't, keep the course. And I think a lot of the work we've done, especially over sort of the COVID period, was a very unusual period, and I think NZ Funds is an active asset manager, and there are points in time where, and we think clearly COVID was one of those where you needed to be, I think, very active in terms of the way in which the portfolios were managed and the way in which they were positioned. But certainly as markets generally reset in terms of their levels, in terms of interest rates, in terms of share markets, that gave us a real opportunity to step back and say, well, where is the true north for each of the portfolios? Where should they be over a very long period of time? And what is the plan in different environments? So, and to bring that closer to home, August period is that sort of great example of, we had a positive view on markets. We've had a positive view on markets for the last sort of 2 years. Question was, that's our plan. That's what we're heading towards. Did August change anything? And clearly to us, the answer was no. So it didn't change anything in the portfolios, and markets are back basically close to their highs. So I think that's the best thing to try. We've learned, and we're always learning, but we'd definitely say that to clients. It's just take a breath, look at the plan, try and think of what has something actually changed.
Fantastic. Probably part of that is think decades, not years, which for most of our investors, they have longer time horizons unless you can buy a house or transact in the near future, and even then it forms part of something broader. But that's a great lesson. Mark, have a plan, revisit the plan if you think you need to, but generally stick to the plan.
Cool.
Thank you everyone for joining us. Look forward to speaking with you again soon.
Thanks.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.